All
Yes.
right, perfect. All right, well, we're going to jump right in. Welcome and Happy New Year. I guess we could still say that. We're a week and a half out. It felt like this Thanksgiving, Christmas, and New Year flew by, but here we are in 2026 already, and we're going to get going on kind of what's happening in the markets, what we can expect, and well, I think it's going to be a good year. So I'm excited for that. I'm going to go over why I think it's going to be a good year here and we'll take it from here. So first off, let's make sure everyone knows that we are going live again, live every Monday, 10 a.m. You will get to see what's happening with the market on a daily basis or on a weekly basis, live again at 10 o'clock on Mondays. So if you guys can join us, then that'd be great, and we're excited for that. So live 10 o'clock on Mondays. But let's get right into the nitty gritty. What is happening in the current market and what's happening in the mortgage industry right this second? And to start off, we got a doozy of a gift, a New Year's present from the administration. They announced a $200 billion gift to start off the 2026 year. Now, what that gift was, or is, I should say, is it's a fantastic QE present to start purchasing mortgage-backed securities again. So I don't know if you remember, but back during the pandemic, we had very low rates. Part of that was due to the fact that the federal government was spending a lot of money, like 60 to 80 billion dollars a month over a almost 2-year period to purchase mortgage-backed securities, and that drove down interest rates rapidly. So we are getting a $200 billion gift that was just announced this last Thursday. Now, if you look at the markets, this candlestick chart shows you what happened just on the announcement of that. We saw this little green candle go all the way up to this Fibonacci level here, and it stopped. But the next day went all the way up past the next one, but then it retreated. And now we're kind of back here. So we're better than we were. We saw a nice jump above this level here, which was a sticking point for us for a while. So mortgage rates improved just on the idea that we were going to get this. So as it's being implemented, we'll have to see how that actually impacts interest rates above and beyond what we already forecasted. So that's just an extra gift that we're going to be seeing. And then, well, this is going to be an overall really, really good thing for mortgage rates. And we'll keep that going. Hopefully that'll go throughout the year and we'll see more of that. So here's an idea of where we're at right now. If you look at where we are on the mortgage-backed securities line, we actually already hit this level back in August of 2024. It was very, very short-lived, but mortgage-backed securities gained ground. Rates got better and better and better, and then we hit the same spot that we hit today or this last couple days. We hit that same spot and only stayed there a couple days before retreating. So we're in a very volatile space right now because it only stayed here a few times. I'm hoping we can stay here. Hopefully, we will stay here and not retreat back. But you'll see in my forecast and what I think is going to happen the rest of the year. Um, I think we will stay here or get a little bit better, but it's never in a straight line. There's always ups and downs. But this is a really good sign. But notice we've only hit here in the last only twice this level in the last 2 years. So this is a very rare occurrence, and rates are very good right now. And here's an interesting thing. Right now, the 10-year is at the 4.18 roughly level. Well, when the mortgage-backed securities reached their peak that we're equal to right now, notice how high they were here. But notice the difference, the gap in the 10-year. So why are mortgage-backed securities the same on these dates, but the 10-year was way lower back in the same month or the August of 2024. And the reason is the gap between the 30-year and the 10-year is shrinking. And that is what's causing mortgage rates to come down as well. So we'll talk more about that and what that means for future rates as well. And let's get into it. So currently interest rates are right around 6% on a 30-year fix. Now, keep in mind, this is a perfect borrower, conventional 30-year fixed, primary residence, 25% down, 800 credit score, single family detached residence, 30-day lock. It's perfect. So if you're a condo, if you have a 710 credit score, if you're putting 5% down, your rate will be different. It's all based on risk. This is based on what people like to market, right? Everyone markets the good rates. They don't market those rates that are going to be higher because they want their phone to ring. So when they market online and they tell you what the rates are, they're going to give you the best of the best to make the phone ring. And that's what this is representing. So if you have customers that are getting a little bit higher rate, it may just be due to their circumstances, the property, etc. But overall, very, very good right now. And let's get right into the forecast. So first off, we want to go over what influences mortgage rates. So inflation is one of the biggest things, which we've seen coming down. We'll go over that in a bit. Employment is also a very big impact on rates, and so does the country's debt and the bond activity. So we're going to go over this, but these three pieces of the puzzle are what really influence rates. The Fed, their dual mandate is to control inflation and employment. So that's the Fed's job. So they'll lower and raise the Fed funds rate to try to keep these in line. But overall, these three items have major impact. And there's other impacts as well that go on in this market. Going to war, all kinds of different things have an impact. So we'll go over that in detail. So first off, let's look at where we've been. Like Maya Angelou said, to know where we are going, we need to remember where we have been. In 2025, the 10-year Treasury forecast was supposed to be at 3.8. We ended up hitting average of 3.9. We went below that as well at some point, so that was kind of nice. But when we keep going on the 30-year low rate target, what was the target at the early then? We forecasted 5.7 to 6. We only hit 6.1, and so it was. It's not the lowest we saw. We were kind of off on that hit, but I think it's because of the gap in the 10-year and the 30-year, and we'll go over that in detail. The next one is the mortgage spread. So the forecast between the 30-year and the 10-year was supposed to be 2.25. We started the year with a 2.8% difference between the 10-year rate and the 30-year. So the forecast was that was going to shrink to 2.25. We actually ended up shrinking to 2.2. So that's why you saw the 10-year being so much lower back a while back, but rates being the same. We bridge that gap. As this gap shrinkens, so do rates. So home price appreciation was forecasted 3.5. Overall, it was a little weak. 2.6 was one of the highs, only 1 to 2% last year. So pretty weak. But that's the recap for 2025. The unemployment rate, that's the one thing we can't ignore. We started at 4.1 with the unemployment rate. So it became 4.5. 4.56 is the actual right now. So we start at 4.8, 4.1. It was supposed to get to 4.5. We're at 4.56 now. So interesting. Some of the stuff that we forecasted came true. I think the appreciation was a little weak. We're better on the mortgage spread, which is good, and that's going to get even better as we go. So let's look at inflation real fast because that's one of the biggest pieces of the game. And there's two types of inflation. There's headline and there's core. The PCE is the Fed's favorite gauge of inflation. The core is what they really like to focus on because it removes food and energy, which the Feds have no control over. So they like looking at the core. Shelter, just the shelter itself is 16% of the headline core PCE, headline PCE, and 18% of the core PCE. So shelter is the rents. Basically, a roof over your head is 3%, is 3.7%, and so that's a big chunk. That's pretty high, but it's 16% of the overall score. Now, if you look at the CPI, Consumer Product Price Index, if you look at this, shelter makes up for 35% of that inflation figure. So right now, the headlines is 2.6 and the core is at 2.7, the core is at 2.6. Not bad, but the shelter makes a massive component of this, and shelter is trending lower. and it's kind of lagging. So this is going to bring us really good inflation because it's a lot cheaper than what's currently posted. Now, the BLS uses only a sixth of the country's data every month in their methodology to do like employment numbers, and it's kind of messed up. So a lot of these numbers are kind of skewed. But let's look at the rents equivalent, and we'll see what the current trend is. Because right now they're saying we're at 3.7. In reality, it's a lot less. But look how much shelter is trending lower. The cost of rents is going down drastically, and that's a huge impact on inflation because it makes up 37% of the inflation numbers. So as this comes down, so does inflation. As inflation comes down, so does overall interest rates. So if you look at actual rents right now, we're negative 1.3 on the new rents, which is way low, but renewals are actually at positive 3%, which is traditional. Now, the reason there's a difference here between brand new rents and actual renewals of people that are already in their house, people just don't like to move. So they would rather pay a little bit more and avoid the hassle of moving. Whereas people getting out there and finding a brand new place to rent, there's a little bit more competition now, so they're able to get a little bit cheaper on rents. But overall, the shelter component is coming down. So inflation is coming down, and we're excited about that because the lower the inflation is, the lower mortgage rates are. So we're looking really good to start off this year for the future. So core PCE inflation is at 2.8. So we think this is overstated. We think it's closer to 2, and here's why. The overstatements that are in here, tariffs are being considered a continuing inflationary piece, but they're only a one-step effect. It happens once and it doesn't happen again. So it only has an impact on one gauge of the inflation, and then it goes away, and then it comes back down, and there's no additional 0.3% for tariffs. So it's just a one and done. It's not like typical inflation that is more like a stair step. Every month it goes up that 0.3. This is a one and done. So that's overstated, I think, in these numbers. And then if we look at the shelter lag of the 0.3%, we're looking at a total right now of about 1.9 for the actual PCE inflation. So as the numbers shake out, we should be closer to 1.9, which is where the Feds want it to be. And that's the forecast that we're looking at. The overall 12-month forecast, though, is 2.5. It's going to take a little muscle to get to the 1.9, but 12-month overall 2.5. So this is kind of that stair step I was talking about on normal inflation. The tariffs only hit once, so it's overstated. So here's the Truflation. I like the Truflation forecast because it takes in 10 million data points. And right now, the Truflation inflation number is 2.05. So we believe that it's being overstated right now. And if it does come down to the actual inflation numbers of 2.05, that is going to really, really, really help mortgage rates. So we're really, really excited for that piece as we move forward. The lower the inflation, the lower the rates. So let's look at labor because employment has a huge impact on overall rates. When we saw all of the really crazy employment figures coming out from the BLS with over 250,000 new jobs being created, and we saw this massive employment, how the market was really hot, they kept rates high because of that. The Feds did not want to cut rates because the forecast for labor was strong. Well, those numbers we learned were fake. And I'll go over that in a second. They were terrible. They were horrible. They were off by more than 70%. And the reality was a lot less. Well, now we have a little bit more real numbers. So let's look at where we're going as far as initial claims, unemployment claims. Notice how they are going up. There was a little dip here, and then they're coming back up. The initial claims are a little higher. So that's a good thing for the overall and the overall jobs, the overall economy when it comes to mortgage rates, because higher unemployment is good for mortgage rates. Strong economy equals higher rates. Weak economy equals lower rates. A stagnant economy equals lower rates. So if we're stagnant, if we're slow to go to the markets as far as jobs go, that's good for mortgage rates. We don't want a hot economy. Hot equals inflationary, which means higher rates. We want a stagnant one. If we're focused on mortgage rates, that's what we want. Notice the job openings. It went in 2022 from 12 million job openings to now only close to 7.1. That's a massive decline in job openings. And also, we think this is overstated because companies now, because of COVID, there's a lot of work from home jobs. So these job openings that are being posted on the jobs sites, one job could be posted in 10 different states. So it's counting as 10 job openings if that is the case, which could skew this number, and it could be even less than this. So overall, job openings is a little weak. That's helping mortgage rates. So overall, what's bad for the economy is good for mortgage rates. Sometimes we don't want a bad economy, but we do want an economy that is mortgage rate friendly without hurting the jobs tremendously. So that's what we want the Goldilocks. And here's the private payrolls that came out. The ADP, they were showing 200,000 new jobs back here in October of 2024. We were negative. Actual job losses in June of 2025. Keep in mind, we were negative here and negative in September and negative in November. And this is when Fed, Mr. Powell, was still stating that jobs were strong. So I just think that's inaccurate. I think the data is, he's looking at the average. The real data shows a different story. So I think there will be additional Fed cuts. I think they're going to be stalled for a little bit, but this will lead to additional job cuts, or not job cuts, additional rate cuts on the Fed at the Fed funds level, and we will hopefully be able to see that soon here. So here's the BLS jobs report. Mind you that these were overstated and they're still weak. BLS is still weak. Remember, there was 350,000 jobs said that they were here, but they were wrong. Now they were negative in October by over 100,000. Imagine if they overstate this what they really were, and if they overstate this what they're, so the jobs market's weak. And it's still, and it's weak, and it's still overstated on this BLS report. So the reality is the jobs market is weak. And if you're trying to find a new job right now because you were laid off, it's more difficult. People are staying on the unemployment longer, and it's just tough in the job market right now, which should yield to lower mortgage rates. So here's the job revisions. The BLS, the initial was 1.923. The final was 1.543 million. That's way off. That's off by 4.42 million. And then the overstatement of 1.5 million overall, there was a 1.14 million overstatement overall, 73% wrong. So it's a very bad model, the way they try to bring out and tell us what the jobs numbers are through the BLS. What's the worst part of it is it affects the mortgage rates instantly when the jobs numbers come out. But when there's revisions, they don't revise the mortgage rates. They stay at the highest point. So it's frustrating, but it is what it is. And we have to just live with it. So the unemployment rate right now is 4.6, came down actually a little bit the last reading on Friday. But overall, the unemployment rate is rising, which will help mortgage rates. The overall forecast is to go from 4.56 to 4.8, which is good for mortgage rates. Hear the trend, guys. Things are good for mortgage rates. So the Fed, what will the Fed do? Well, I want to kind of show you who the Fed is real fast. There's 19 Fed members. There's 7 governors and 12 district bank presidents, 12 voting members. Now, out of the voting members, there's 1, 2, 3, 4, 5 that are dovish, that want cuts. 3 of them that are centrist, and basically right in the middle, that can be swayed either way. And there's only 3 that are hawkish. So most likely, with the new Fed chairman coming in, we're going to see more dovish stance, and we should see additional cuts this year, and it should lead to mortgage rates coming down. Now, when the Fed cuts interest rates, what they do is they present that typically 2 to 3 weeks in advance, saying the odds of us cutting interest rates are about 100%. That's typically when the markets react. The day that the Fed actually cuts the rates, the markets already have absorbed what they believe is already going to happen. So when you look at the Fed funds rate versus the mortgage rates, you'll see they actually mirror each other very well. So when the Fed cuts rates, they mirror each other very well. So how come the last three times, the day that the Feds cut the interest rates on the Fed funds rate, the mortgage rates actually got worse? Has nothing to do with the Fed cuts because those actually hit the markets and made mortgage rates get better like 2 or 3 weeks prior. It had to do with the reporting on jobs numbers, et cetera, for those days. So it just happened to be a coincidence. But overall, you can see when the Fed cuts rates, the mortgage rates typically follow the Fed funds rate. So as the Feds will cut this year, mortgage rates should follow, especially with the skinnier margins between the 10-year and the 30-year. That's going to help rates come down as well. So what is the forecast for the Fed funds rate by the end of the year? We think it's going to be 2.875. That's the Fed funds rate that will end at the end of the year. And what will that mean for mortgage rates? Drum roll. Brrr. Well, let's have a look at that. Mortgage rate forecast. If Scott Bessent wants what he wants, the Bessent to target is for 10-year Treasury is 3.9. So if the Treasury is 3.9, that's a quarter better than now. Then that will mean a quarter better in interest there. So we're going to get a quarter better on interest rates because of the 10-year coming down. And then we have factors that influence the overall mortgage rates. We have additional debt. That's going to be a bad thing if we have a lot of more debt, a lot more treasuries being sold. We have the terming debt as shorter. If we can move the long-term to short-term debt, that's going to help mortgage rates. We have the Genius Act that is going to have short-term treasuries be the catalyst for a lot of the digital currency and stable coins. That's going to help mortgage rates. We have the Fed QE. They announced 40 billion in short-term debt the first half of the year that they're going to be buying. That's 220 billion. They also announced the 200 billion of mortgage-backed securities. This is all going to help rates. And then some bank deregulation. So banks are required to keep some amount of cash on reserves, and that money just sits there and doesn't get any income. So there may be some deregulation where instead of that money just sitting there doing nothing, they can reinvest that in guaranteed returns on treasuries. That will give the banks more money or more income, driving interest rates down even more. That could even help overall as well on the short term. So good news coming out of that. I want to show you the 10-year Treasury because when we say there's a gap in the 10-year Treasury, look at where the 10-year Treasury was and where it is today. They're thinking we can get the 10-year Treasury down to the 3.8, which is going to be all the way down here. Plus, if that gap shrinkens, it's going to just categorically improve even more. So the 30-year fixed, the rate spread above the 10-year Treasury is really interesting. So we're at 2.12 right now. The spread should be 1.8. So we're going to get about 30 basis points better if we look at what the goal is. And if you look, I'm going to show you a chart real fast. But if you look at this, this is going to drive interest rates lower. It's going to help people with refinancing, and we should get rates in the fives. So we're going to look at it one more thing too, because remember how we always say in the stupid, cheesy little line, date the rate, marry the home. Goodness gracious, where's my coffee? Here it is right here. So we want to date the rate, marry the home. Date the rate because we can't time a purchase on when rates are the best. And look at, this is a chart showing that. This is when rates were their best. There was only a very small window of opportunity to get the best rate possible. It's very minimal to time things when rates are at their best point, right? So if you are waiting for this day, you're going to miss the boat when you go into contract because you might not find the right house. It's just not good to time. So if you're trying to time the markets as trying to find the best rate possible for your purchase, it's kind of a fool's errand because it only hits for a very short period of time before spiking. So just be careful of that when you're with your customers are saying we're going to wait for rates to drop. They will be dropping. I guarantee that this year we will see lower rates because everything I've already told you about. So what is that forecast? Where are we looking? Here we go. Right now, the 10-year Treasury is at 3.8. 1.8. The spread is going to narrow to 1.9. You add those two together, that will get you what we expect the average rate to be with no points on the perfect borrower at 5.7. So that's my prediction. That's what the people I follow are predicting. That's what we overall think rates will hit this year. It could go lower, could go higher. It could only hit 3 or 4 times. That's why we say marry the home, date the rate, because we can't time it exactly perfect when purchasing, but this is where they will be. So buy the home. You eventually will be around 5.7 with no points at some point this coming year. Exciting news. Here's what other people are predicting, and they're not looking at this spread shrinking. They're just looking at overall right now if everything would stay the same with the spread. And most of the current indexes are in, I mean, Fannie Mae 5.9 forecast, National Association of 6. They're pretty pessimistic. So I believe we're going to be better than this. So does the MBS Highways. If you listen to Barry Habib, who has been one of my mentors over the years as far as how he looks at the markets, and he is just amazing at how he forecasts the markets. 5.7 is where he, and I believe him, we will be this year. So I'm excited. I hope this will hit sooner than later. And with that 200 billion hitting the market for buying mortgage-backed securities, I really think that it will hit. And I'm excited for that.